right, structured notes. We talked about this a little bit earlier in the video. I'll try to make this short, but I also want to make it informative, impactful, and helpful to understand, what they are. So we have a share class dedicated specifically just to structured notes. As by way of background, I was at a large global brokerage firm for almost 10.5 years. A big reason why I left my position is because I had to get to a point where I could help bring this more to market, talk more about it, and not gatekeep and let it be known that these types of products exist, because they truly did change the way I look at investing. They changed the way I look at portfolio management. I think that absolutely is a consideration people should have when they're looking to get into the world of investing. So structured notes, what are they? They're a debt security backed by banks. Okay, banks like those that you have heard of. JP Morgan, I'm not the greatest laser pointer drawer, so bear with me. As you saw at UBS, we own notes on UBS. Citibank, we have notes with Goldman Sachs. Some of the international banks we work with, ENP, SocGen. We take our structured notes to market and price them against multiple investment banks, all of which have very, very credited and good credit ratings. We could talk about that a little bit more in detail, but ultimately make sure that we have good backing for the notes that we're buying. And so what a note is a corporate debt security backed by the bank, like we said, and then they track an underlier or an index. So in this particular example, we're going to talk about growth notes. So growth notes pay one time, and they have certain features attached to them, which we're going to discuss and go through here. This particular growth note, so you're going to get your one-time payout. It's going to run, if it goes the full term, 3 years. All the notes that we buy in our structured note portfolio run 3 years. The reason being, we found in our testing that there's smoother returns and a better probability of either the note getting called or the protections are going to make sure that we're in a better spot to protect our investors. So what does all this mean? I'm going to talk about this first. If you were to buy, and today is July 12th, this structured note, and this is one that I actually own and still hold, so this is a real example. There is a 40% barrier protection to any of these securities. So you buy these, you're locked in at the price of $7.12. So we'll record that. It's recorded in our ledger. Ultimately, if in 1 year, all three of these securities, in this case, this particular note was going to run out. I bought this back in November of 2023. If this goes out 1 year and all three of these go up 1 penny from the time in which I bought it, I will get paid 30%. So right around time for Halloween, I will be getting a good amount of candy at 30% return. And you will get your principal back. This is how structured products work. So that's scenario number one. Scenario number two is, let's just say, I'll pick Google, doesn't have a good year, and it goes down 20%, and it ends up running the full term. So that's what happens is if in the first year, first 12 months, we get to that 12-month annual no call period, one of these underliers is down, and any interval could be down 2%. It will not get called and run the full participation at maturity. So that you're participating in the full term, participation in the full term of the note. So here's where there's other features we add on and where it gets even more interesting. All three of these securities, you have bought a note, it tracks Google, Amazon, and Microsoft. Of the lesser performing, so the one that performs the worst, you will get 350% of that participation. That's how this particular security works. If you go ahead, and I can let you do this on your own and look at the 3-year worst return, you can make your own determination on whether or not you like 40% barrier protection and being able to get the lesser performing of plus 3.5 times whatever that return is. So if it was 15%, like I just mentioned, over 3 years, you would get 52.5%. If it were 20%, you would get 70%. So there's really a lot to be considered here, but I think that it hits our 3 key pillars of having that capital preservation feature of 40% downside. We're still making a substantial, and this is more than double what the average S&P return is at 30%. If it goes up 1 penny, let's just say that doesn't happen. We're tracking the lesser performing of these 3, and then we're making 350% on that particular equity. That is a little bit about structured notes. Again, this is a real one. If you wanted to see real quickly how it's performing, I could show you. So this is the note we were just discussing, term 36 months, protections, and all those features. Notes, and I want to give a quick education about this. Notes trade at a bid and an ask on the secondary market. A common misconception is that you cannot sell them, that they're illiquid. That is not true. I have sold out of these notes, and there is a market for them, generally more often than not, and you can trade them intraday. So how is this note doing? This is a pretty low value investment because I like to spread my notes around in our portfolio, but at the time, it was in my own personal account. This is actually now in our fund account, so we just put this one in our fund as well. But it's up 25% 30%. It was issued on 11/03/2023, and as it's tracking right now, these were the initial prices, these are the current prices. So obviously this looks like it's absolutely going to get called, and I will be making that 30% on this investment. So what we do is when we get called, we look at it in the same exact or like kind investment and continue to keep the machine moving. So we hope you enjoyed this video. Again, Craig here with Swanson Reserve Capital. We are accepting investors still. We have 99 spots within this fund. So we're looking to do a friends and family round on our raise. We're looking to raise $50 million. And as part of the first 10 million we are raising, we will be offering a 1.5 management fee, which is lower than what we'd be offering at a 2% management fee going forward for the life of the fund. The great part about those that are earlier, more so call them seed investors because we have secured capital already. For the first 10 million that we do raise, that 1.5 management fee will last for the entire life of the fund. So any follow-on investment, whether that's $1 million, whether that's $100 million, that will be honored at the 1.5%. We have a hurdle rate, which means we are targeting to make at least 10% on our fund. And then I can share with you more details on our performance structure as well, because we do have a performance structure as well. But if this is interesting to you, please feel free to reach out. We're happy to answer any questions, have a discovery call with you, and talk about this a little bit further. Again, structured notes, I think absolutely worth looking at and consideration for your portfolio, especially not all of it, but to have these type of protections and still be able to make these substantial returns definitely warrants another look. So again, thank you for your time. Thank you for your attention. We're excited about this to bring what we believe is one of the most unique offerings on the market, and excited to partner with you going forward. Thanks again.